Okay, so investment gathering, blah, 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 disclaimer. So please take note, education, not recommendation, make money, be happy, lose money, don't scold me. Okay, I have been getting this question quite a bit recently. Yeah. So of course, we have actually quite a few REITs that are pure US properties and the price has actually dropped. Price has actually dropped. So I've been getting this question. So what should I do about it? I thought of myself do a formal review on this sector and again share with you my opinion, hopefully give you all some directions. In fact, I think I'm going to spend about 1 hour talking about REITs with pure US properties. And then same thing, I'll go back to the review of companies. We'll actually look at 2 US companies, 2 US stocks, and go through the process of how I actually analyze them, how I view them. Same Kahoot exercise. Then we go through the admin. Okay, REITs with pure US properties. Okay, make a guess. Anyone, just for fun, make a guess. How many REITs do we have listed in SGX only with US properties? Make a guess, make a guess. 2 are more, definitely there are more. 5 are very close, a bit more. More than 5, more than 5. More than 5. 6, thank you so much. So we actually have 6, 6 pure US properties. Just for the fun of it, okay, make a guess, make a guess. How many pure REITs with only Singapore properties that do we have right now? How many REITs that only has Singapore properties? Make a guess. 3, only 2. So in fact, now there's only 2 REITs with pure Singapore property. I think one is Sabana. The other one, I think it's Far East Hospitality, if I'm not wrong. Only these 2. The Fraser Center Point is arguable, but they actually only have Singapore properties, but they are also invested in a Malaysian REIT. So I won't consider. So in fact, only 2. Okay, what I'm trying to say here is this. So in fact, it's actually quite a large chunk, relatively speaking. I mean, Singapore REITs, yet we have more REITs that are pure US than pure Singapore. Okay, so these are the 6 REITs we have. Eagle is suspended. Okay, Eagle is suspended. I think for those who still have them can write off already. The last check, their book value is gone already. So it's actually quite a sad case. I mean, things happen. So this is the part of the risk of investing. And of course, I mean, even I think there is certain fraudulent nature, if I'm not wrong, inside. So even the exchange, the experts, they also didn't detect. So this is part and parcel of investing. So that's why we need to diversify. So personally, yes, I also have some stake in Eagle, but like I said, it's like 1 out of 40. Yeah, it's not something that after that I have to sell my kids away. So without Eagle, we have 5: ARA, US, Keppel, Manulife, Prime, US, and United Hampshire. So for them, it's pure US. All the properties are actually in US. Okay. Now, why? Thank you so much, Sarinta. Okay, so why I actually want to talk about this? Apparently, these REITs, of course, REITs in general, the price has actually been whacked down because of the increase in interest rates. But for this group of REITs, they are actually whacked even further. Okay, they actually got hit even more badly. Just to give you a sense of what I mean by more badly, like for example, this is ARA. Before crisis, you are talking about 80 cents. Okay, US dollar 80 cents. So now it's about 30 cents. Okay, 30 cents. It never actually went back to pre-COVID. Keppel Pacific Oak, same thing, was hovering about 80 cents, also down to 30 cents. Okay, yeah, so there was a sharp drop here, as you can see. Manulife, $1, now become about 17 cents. This one dropped almost like 80%, 80% drop. Okay. Prime prime again pre-COVID about $1, now about 23 cents. So it's about 80% drop. So it's actually quite bad, quite bad. And United Hampshire, okay, this is the one that probably wasn't that affected. Okay, so except for this one, of course, later you will see why this not affected. So I believe the IPO about this point in time, so about 50 cents, now it's about 44 cents. So except for this one, so the rest, you're talking about very sharp drop, almost like 80% drop for some of them. Okay, so question comes up for those I have, is it time to cut loss? And from another perspective, if I don't have, is it a good time to go in? So this is what we're talking about today. So the first thing I did is I actually collated some basic information. These are the information I've collated so far. As you can see, I have number one breakdown in terms of property type. Okay, as you can see here. So ARA obviously is a hotel REIT. So by the way, they have a very famous brands. I think like Hyatt, if I'm not wrong. Yeah, some of the top US brands. Okay, but you have to understand they are quite interesting one. It's not they have like homestay type, like Hyatt, but it's like 2-star hotel type. Okay, anyway, if you're interested, you can just go in and visit. So basically they're hotels. The office is the one that got hit the most. The office is the one that got hit the most. Then of course, United Hampshire is actually not hit. I wouldn't say it's being hit at all. So basically the price hasn't changed much. Okay, maybe let me just check what is the IPO price. If I'm not wrong, it's not a lot of difference. IPO price for United Hampshire US REIT. Oh, okay. Sorry, also quite bad. That was 72 cents. Then now it's 44 cents. Yeah. So yeah. It was IPO about 2020. Okay, so let me just look at the chart again. Yeah. Okay, so in that sense, yeah, but relatively speaking, it still got hit the least. Okay. So a few things that I want to point here. Number one, you look at the dividend yield. So by the way, this is a historical. That means I base on last year's actual dividend. Okay, historical. So Manulife, you're talking about 30%. Wow. Dividend 30%. So Prime US 28.5, Capital Pacific 17.3. Okay, very good. I'm quite sure you know what I'm trying to get at. Okay, so ARA, even though it's 9.1, it's also considered high. If I could recall, normal times, so hotel, you're talking about 6+, 7+% yield. Okay, 6-7% yield. So 9.1 is also quite high, but of course, compared to this is still low. The United Hampshire, 13.1% also considered high. So again, if you actually use about 70 cents, that means you're talking about the standard yield, at least IPO, you're talking about 6%, 7%. Okay, so 13.1 is also quite high. Yeah, thank you so much. I also was talking about this book value. So one thing to note is this book value now is actually considered very attractive. Okay, very attractive. You're talking about 70% discount, 60% discount. So based on book value is actually very low right now. But you have to understand this. So this book value is there is an element of academic exercise as well. Okay, why do I say that? So when they value a property, it's actually quite academic. Okay, so how do they value a property? So usually they go by a comparative method. So like, for example, I use like a residential is easier. Let's say my unit, okay, my apartment. So how much they think that my apartment is actually based on, let's say, my neighbor. How much did my neighbor sell? Okay, if my neighbor sell for 1 million, then they think that if let's say the unit is exactly the same size, then they think that my value for my unit is also 1 million. Okay, but the thing is, if when I sell that time, really can fetch 1 million or not, nobody knows. Is there any buyer or not? That one nobody knows. Okay, hope you know what I'm trying to get at. So basically, now the value of the property is there. But the question is, if let's say really want to sell, anybody will buy or not? That is the question. So to answer your question, is the book value still good after discounting the debt? My sense, of course, this one need to take a bit more. My sense is if they really need to sell, they will be in trouble. So basically, the answer to it is no, the book value will not last. Okay, so very likely they based on last transacted value to determine the value of the property, which of course, based on the oversupply situation today, it may not last. Or put it this way, if let's say when I'm going to buy, I won't buy based on the last transacted price. I'll probably ask for a deep discount. Okay, but of course, if they are in a situation whereby they can hold, and on the assumption that everything comes back well and good after a certain year, of course, now if you buy, it's at a very good price. Okay, so it's a lot of assumptions, a lot of question mark here. I don't understand, but no choice. No choice. That is the nature of investing. So that's where the risk element come in. So my point here is this: if let's say the REITs cannot take it anymore, they have to sell at this juncture, I think it's dead. They probably have to let go at very cheap price. But if they can hold, and on the assumption that things get back, if you buy today, of course, it's a very good price. Okay, hope it's not confusing. Okay, so anyway, which way will happen later, we will have a little discussion. Then probably, because we're not foretelling the future, nobody knows best, then maybe we can learn from each other on this. So anyway, these are the numbers at this point in time. Feel free to key in questions and comments while I actually discuss. Like I said, I don't have all the answers. Okay, really, this session is for me to facilitate. I am quite sure some of you are familiar with some of the properties, definitely more familiar than me. So please feel free to share, and everyone can benefit from this session. Okay, so I thought these are some of the burning questions you all have right now. So if I don't have the REITs, is it time to buy? Or should I just avoid this whole sector together? Okay. I know there are some of you who have the REIT. Okay, I'm sorry. Okay, by the way, I'm one of them. Actually, I own the Keppel Pacific Oak. Luckily, the rest I don't have. Okay. Is it time to sell to cut loss or just wait a bit more? Okay. So I am coming from my perspective on how I actually analyze the situation right now. So hopefully this can be a reference to you, because a lot of people always ask me, how should sell or should not sell? Yeah, this is how I will actually look at the situation. Okay, of course, the process is actually quite standard. Okay, if let's say you have some certain other stocks whereby you think I want to sell to cut loss, maybe you can actually use the same process. So of course, number one, I want to understand why there is this drastic drop. Why is this drastic drop? Okay, answer is very simple. The US employee enjoy work from home so much that they don't want to go back to office. Okay, so we all know during COVID period, all work from home, but Singaporeans somehow very guai. I think Singaporeans cannot stay at home for too long time. Okay, so all cannot take it. Once can go back to office, all of us go back to office already. Okay, I'm quite sure you all know if you go back to CBD, now it's packed. The roads are packed. The train stations are packed. The food court is actually back already. Okay, somehow Singaporeans we cannot tahan stay at home. Okay. Whereas for US, it's a different story altogether. So they work from home, they get so used to it, they refuse to go back to office. Okay. So I must say that this one is something unprecedented. Maybe we can do a vote later to see whether things would change. But it never happened before, this kind of situation. So it's a bit of a cultural change. So that is something I think. That's why it's a quite headache. You know, maybe later you can take a poll as to whether, do you think that eventually they'll go back or they will not go back? But I must say this kind of case didn't happen before. So let me just share with you some numbers to see how serious is the problem. Okay, now based on the headlines, average office vacancy rate across US rose from 16.9% from 12.4%. Okay, so that means vacancy basically how many percent are vacant? So increase from 12.4 to 16.9. Okay, but there is actually this company that tracks the office occupancy by swiping of the card. Okay, by swipe. Okay, they believe that now for New York, or at least for New York, the occupancy rate is only about 49%. That means vacancy is 51%. 51%. Half of the office are actually vacant right now. Okay, San Jose. So I think, if I'm not wrong, this is Silicon Valley. So please correct me if I'm wrong. I'm really not familiar with US. I only went to US once, twice, maybe 3 times. Definitely not a fan of US. San Jose is Silicon Valley, right? Can someone help to confirm? San Jose, is it Silicon Valley or some tech place? Anyone can help me to confirm? San Jose. Okay, thank you so much. Thanks. Okay, so 37% of the office is actually being used. Again, this is by swiping. San Francisco only 41%. Okay. Thank you so much, Eric. Sarinta, you're correct. ARA is a hotel, not office, but of course we are talking about there's a lot of hotels, a lot of offices. Okay, so this is the reason why the prices for US properties came down very sharply. Okay. So what I've done again is to drill down in terms of numbers. Drill down numbers, and again, these are some of the numbers I have picked up. So even for hotels, I have also not think too highly of the hotels also. Okay. So these are some numbers I picked up. So what I did here is this: I actually took the pre-COVID numbers, 2019, and I look at the most recent one. Okay. And of course, to be safe, I also look at the gearing ratio, and interest cover, debt ratio. So ARA, okay. So even though they are hotels, usually they are linked, because if let's say you work from home, then you also travel lesser. That is the thought I have. That's why they're affected. It's true enough. You can see the numbers is actually being affected. Came down. Keppel Pacific Oak actually is minimal. But then I don't know in terms of in terms of people going to the office. So this one is actually still on lease. That means based on rental. Okay, but the rented one, are there people going in at that one? I don't know. Okay, but there's a drop. Okay, can you see the Manulife and Prime? The drop has been quite significant. So this one almost 10%. Can you see? And again, this is based on rented. So out of this 86%, how many people go back? That one is going to be lower. Prime US REIT also same drop. Now the good thing is the United Hampshire, okay, in fact it has went up. So you all have to understand the stock market. Okay, especially for those who actually want to take a bit of risk to capture opportunity. So very funny one, when they say US is bad, all the US stock will come down. But there are some stocks, if you ask me, also nothing to do with me, why I come down. So of course, it's high risk. Just like same during COVID period, all the stocks came down, including the medical stocks, including stocks like Riverstone, Top Glove, which business it becomes so good. Okay, so United Hampshire is like the price also came down, but what's it going to do with me? In fact, my occupancy went up. You can say that the hotel also affected because if you work from home, I also travel less. Correct. Last time I have to go and travel to visit. Now they are all at home. May visit who? Also nobody to visit. Anyway, I can Zoom and meet already. So there's no need to visit. So also affected. But for retail, they are renting out to what do you call that? All the marts and so on and so forth. Your shopping mall is actually still there. So they actually rent out to the huge shopping mall type. So basically, just to give you a sense of United, just to give you a visual, because I do understand that a lot of people not familiar with these REITs. Let me just give you some visual. How do they look like? Okay, yeah, something like this. So it's not your like Raffles City Mall or not your Takashimaya. It's, if you go to US, they have all these, I think they call them outlet mall or something like that. Very huge. Then you have one major tenant type. Okay. So that sense, all this is actually still operating quite okay. Okay, there are some questions. Some question and comments. Just let me take a look. We all enjoy going to the office. Property too small to stay at home. Bosses don't trust us working from home. Also, USA people might stay very far from their office. Some travel in 1 hour by car one way. Yeah, that is correct. So, yep, usually they have to travel quite a bit. Now got chance. No need to go back, work from home good. Why want to travel? So, yeah, I think all this is very different from Singapore. Okay, thanks for all the comments. Let me see. Okay, I think it's the 49% and 41% are the numbers of people heading back to the office, not really occupancy, which is much higher. Okay, let me just... Okay, so just to clarify, Katipan, so what happened here is this, the occupancy rates, the official one is about 80 something, 80 something percent. Okay, that means the company actually still rents the space. Okay, but what this guy is saying here is that even though the company rent the space, their staff is not going back. And if you are the company, my staff don't want to come back, and then what I'm going to do, of course, I will eventually let go of the space. I think this is what the article is saying. Okay, so you're right in the sense that currently the occupancy, at least for across US or based on this article, is still 80%. Seems quite healthy. So the worry is going forward. If let's say only 49% of people come back, then of course the company will start to release. Yeah, so hope we are in line in this. Of course, feel free to comment. Hey, thank you so much. Low number of fees, of course, yes, it will affect other business, car rentals, and so forth. Yes. Okay. Okay, Strainter, I know you're very focused on ARA. Okay, now, okay, for gearing, so luckily I did the gearing and interest cover. Can you tell me, anybody pass or not? or which is the REIT that, there's only one REIT that passed my test, in fact. Which one that passed my test? Okay, thank you so much. The Kappa Pacific Oak US. So in fact, the rest all failed my test. So that is quite worrying. Okay, that's quite worrying. That means you have the occupancy coming down and the borrowing actually went up. That is actually quite scary. Okay, can someone remember for REITs, what is the maximum amount they can actually borrow based on the property value? Thank you so much. 50, not 45. 50%. 50%. So with this, there's actually one particular REIT which is quite worrying. Anyone can help me to point out? Okay, there's one particular REIT quite worrying. Okay, thank you so much. Now, what happened here is this, assuming that after the valuation, so if let's say the valuation drop, okay, and if they breach the 50% gearing, so they will actually get okay, they will actually be required based on the REITs law to actually reduce the amount of borrowing. Okay, reduce the amount of borrowing they have. So if they don't have the money to pay off, so basically there are two main ways, three two main ways for them to reduce the debt. Can anyone know what the two ways are? Yeah, so in fact, answer to Casey's question. So thank you so much. One way is to raise money from the shareholders. Basically, raise money from the shareholders to actually go and pay down the debt. Thank you so much. The other way is to sell the property. And of course, if they have to sell the property at this kind of timing, it's actually going to be quite sad. All the sharks will start coming out. Unfortunately, that is the business life. Once they see blood, or nobody will kind of pity you, sayang you, or all the sharks will actually come up. Dean Manulife just sold off their crown jewel. Okay, I'm sorry, I actually didn't catch that news. But this is the latest that I actually got okay, from their I think I got from their, what do you call that, their presentation report. Okay, I could actually just verify that again. I think I got it from the latest investor report. Let me just verify. Okay, sorry, I didn't follow that closely because luckily I don't have this particular REIT. Okay, let me see. Financial result. I think I got it from here, first quarter 2023. So this is actually quite recent. Gearing 49.5. Yeah. So did they talk about selling? Yeah. So this is actually quite recent. So if it's the property is actually being sold last year, that means this is after the sale of the property already. Chun Woon, hope I answer your question. Okay. This one is this position, that means after it's actually being divested. Oh, okay, no, sorry. Okay, wait. Hold on. Okay, if you are talking about this, completion date is 12 April. So it's divested. Oh, you are right. Okay, so maybe it's before. Thank you so much. Because this is based on first quarter. Okay, Junwo, thanks for pointing it out. That means basically next quarter, you can see this number improve. So they already have sold something. Okay, thanks for pointing this out. Thank you so much. Okay. Okay, thanks for all the comments. Okay, great. So basically, what I'm trying to say here is this. Okay, occupancy actually is all affected except for the retail. Yeah, of course, whether do you think this is an opportunity or it's up to you. I would say it's definitely high risk, definitely high risk, especially if the gearing is more than 40%. But if you ask me, I think this one is, what do you call that? Collateral damage. Nothing to do with it, then the price also came down. It's just that I also US stocks came down. I also got hit for nothing that I've done wrong. Okay.
Yiming, can you click on the link that I put in the chat?
Yeah. What? Okay, hold on.
This is the article about the selling stuff, but I don't know go through or not.
So based on that article, based on the report, they actually said it's sold. Let me just make sure it's the same property. Hold on. I mean, it's loading. Oh, yeah. Okay, now they always have advertisement. Okay. Field Tower to sponsor. Oh, it's a different one.
Oh, they start selling a lot of things already. They long already.
US REIT to sell Fifth Tower to sponsor.
This one is dated May 24th.
May 24th, wow, which is actually quite recently. Yeah, so it's actually different. This one I am looking at. Okay, this one is another property. This is Partners Bond. Yeah, so it's a second sale. You're right. Thanks for pointing it out. Okay, yeah. Not too good, not too good. Okay, anybody else has any questions or comments? Okay, if not, I'll move on. Okay, so these are the outlook provided by the REITs itself. Again, I actually get it from the investor report, that quarterly or half-yearly reports by the company itself. So this is what they say. Again, there's no independence. There's no independence. This is exactly what they say. I just copy it, what they say. Now, for ARA US Hospitality Trusts, what they say here is this. Okay, they actually did a forecast for the market. Okay, this is for the market. This is not for their property. Okay, for the market. They basically forecasted that the occupancy is not going to change much. Can you see? Or at least with respect to 2019 pre-COVID, it's not going to change much. So occupancy will basically go back to pre-COVID level for the market. So again, just to make sure it's clear, for ARA itself, 2019, the occupancy is 77%, as you can see here. Okay, but for the market in general, it's only 66% in 2019, and probably when it recover back to 66%. But what they say here is this, RevPAR. What does RevPAR stand for? Revenue per available room. Okay, this is a hotel lingo. Revenue per available room. Okay, is actually going to increase quite significantly. So inflation is really setting in US. My brother is actually bringing his 3 kids to US during the June holidays. I say quite scary. I think he was telling me three days in Disneyland can cost like $2,000-3,000 or something like that. Just the entrance fee alone is $400-500. So the inflation, if you say that Singapore inflation is bad, I think down there is worse. So I won't be surprised that the price actually go up. Okay, so from a hotel perspective, okay, occupancy go back to pre-COVID, but price increase, of course, generally speaking, is actually still good for them. Okay, this is again from their report, from the report. Okay, this one is, let me just confirm. Okay, again, this is based on the market. This is the market, not for ERA, this is the market. So for hotel, okay, mainly the blue bar, the blue bar and the gray bar has been saying, so ADR is average daily rate. Okay, average daily rate. So the blue bar is the revenue per average available room. So look at the blue bar. So it has been recovering quite nicely. Okay, revenue has been quite nicely. Occupancy has been recovering quite nicely. So travel, in that sense, if you ask me, yes, it's slowly going back to pre-COVID. Okay, so again, there's no independence. This is from the ARA report itself. So I'm just sharing some of the outlook for you to make a better decision. Okay, so they also believe that for leisure and business travel volume will increase. This is a projection of 2022, 2023, 2024, but very marginal increase, as you can see here. Okay, you don't expect like what suddenly big jump. Based on what I see, is actually marginally increased, but nevertheless, it's actually back to pre-COVID level. Okay. Again, feel free to have any comments or inputs, questions. Let's share information with each other. For Keppel Pacific Oak US REITs, okay, so by the way, for this REIT, most of the property are not in the major cities. So they are in places like, for example, Dallas, Houston, these kind of places. So what they are saying here is this. Again, this is based on what they say. So most of the gateway city continue to face tough future. Basically, that means the main city, like your New York, your San Francisco, your Chicago. Okay, they are facing tough challenges, and they believe that there is actually out migration. That means companies will shift to the rest of the cities, whereby Keppel Pacific REIT is present. Okay, but they are not able to give some figures of how much is being shifted, blah blah blah, so and so on. For let's see, yeah, correct. So basically, it's qualitative. Qualitative, I cannot quantify. They did mention that, yep, for the major cities, it's actually bad. There's this out migration. Companies are shifting to other cities where their properties are there. I'm not sure anybody can help to verify this. Anybody have any inputs on this? Okay, basically, companies are shifting away from the major cities to some of the second-tier cities. Is that happening in the US? Anyone can share? Or anyone have info on this? Okay, no? Okay, it's okay. And they were saying that the large firms are cutting back from work from home. Amazon, Meta, join and asking employees to come back to office more frequently. Okay, so they have this article, US office occupancy broke 50% in Feb 2023. And the tech layoff announcement yet to result in major decline. So this is from Keppel. Okay, thank you so much, Chun Woon. So yes, Keppel Pacific Oak have properties in Texas, I think in Austin or something like that, if I could recall correctly. So they actually have properties in Austin. We could just do a very quick check. Keppel Pacific Oak REITs. So where are their offices? Yeah, so yeah, Austin. So they actually have this part will be Texas, right? Yeah. Okay, so they actually have offices there. Okay, so for Manulife US REITs, this is what they say in their reports. I just saw this word challenge. Okay, so basically, I think somehow all these reports, they are very frank. So I think they may not be really out of the woods yet. So they have the leasing challenge, increasing costs, high gearing, and asset disposition hindered by limited access to credit financing for buyers. So doesn't sound too positive for Manulife. Okay, this is again in their reports. Okay, I'm happy that they're so frank. Prime US, again, this is based on report. They also tend to be more conservative. So basically, they actually have this statement: economic landscape remain challenged. Okay. So blah 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 blah. Of course, yeah, you all can actually read it on your own time. But I think yeah, this would summarize everything. Challenged. And lastly, we have from United Hampshire. So this one actually quite good news. You can see that retail sales is actually up. So basically, their tenants are actually doing quite okay. Okay, their tenants are actually doing quite okay. So I don't see an issue for the tenant to live, because so these are those like retail, and of course I don't see a reason for the renter to drop. Okay, so this is my answer to the question. Again, I need to highlight the disclaimer. Okay, this is my personal opinion. The whole session is about what I will do. Hopefully, this one give you a reference. This is my personal opinion. What works for me may not work for you. Whatever the decision is actually based on the condition that I'm willing to take high risk. As how the market will move is highly unpredictable at this moment. So basically, whether the people will come back to office or not, nobody knows. Okay, so really please focus on the process rather than the conclusion to form your own decision. So I hope we have this understanding. I know I'm sharing something very physical, but I just want to do it for the purpose of learning. So please don't just focus on conclusion, then make money, keep quiet, lose money, kind of blame me. Don't do that. Okay, maybe before I just run through this chart, just have a sense. Okay, if you believe that eventually the people will all go back to office, or at least most of the people will go back to the office for US, don't mind just help me type a 1. If you think that no, okay, work from home is going to be the new status quo for the US work culture, please help me type a 2. So 1 is they'll go back. 2 is they will. Okay, interesting. Looks like mostly it's 2. So of course, nobody knows, but you know, we at least can see some opinions here. Okay, can see some opinions here. Okay, so this is what I would do. I put down in terms of the REITs. Of course, Eagle is out, suspended, cannot do anything. So if I don't have, will I consider buy? So for ARA, my answer is yes. Okay. because I believe in the hotel recovery story. However, it didn't pass the credit test. So for ARA, I think it actually failed the gearing ratio. Oh, sorry, the interest cover. ARA actually failed the interest cover. Gearing ratio okay, but interest cover failed. Okay. So yeah, I will buy lah, but I will use my gambling money to buy. So I think by now you all know I have 2 pots. That my regular savings investment. So every month I'll just buy a REIT, every month just buy a REIT. That one my wife know lah. I got this gambling money that my wife don't know one. So yes, if I have the gambling money, I will buy into ARA because I think it's oversold. Okay, so to them it's actually all coming back. I believe in the hotel story. Yes, I believe that the RevPAR is actually increasing. Things is actually better for the hotel. Okay, of course, compared to 2 years ago. Okay, so I don't mind taking the risk, and I am talking about getting 9% yield. Let me just confirm. I'm talking about 9% yield. Hey, not too bad lah. Not too bad. Okay. Okay, thank you so much, Sarinta. Okay, but that's me. That's me. Again, like I said, it's high risk because it actually failed the credit test. It's really gambling money. Keppel Pacific Oak, if I don't have a consider buy, same thing is yes. Okay. Now, I actually think that their occupancy will keep coming down. Personally, I think that the occupancy will keep coming down. Later, I have some other data to show you. Okay, what I want to show you. Okay, here. So basically, you can see that the occupancy has actually came down 93.6 to 91.9. I believe it will continue to come down. Okay, for Keppel Pacific Oak. But why I actually still consider to buy? One is, of course, you can see there are still, they still have the money. Can you see? They are still actually very healthy. Gearing okay, interest cover okay. And we are talking about what? 17% yield. So even let it drop drop after that, even 12% yield also not bad. Okay, when I say oversold, okay, so basically market had this term oversold. That means the price dropped too low already. It's a sort of like the market lingo. And unfortunately, but it's also very subjective in nature. Very subjective. I believe it's oversold. That's why you say always say I believe. It cannot be proven as a fact. Okay, so I think it's sold too much already. 17.3%. So of course the risk is this. Eventually the occupancy rate drops so low. Then same thing. They have to have the fate of Manulife. Then they have to start selling the property. Then of course, they'll be in trouble. Okay, so again, it's quite high risk. But for me, I'm actually willing to take this risk to get this 17.3%. Okay, betting on the fact that they still can tong. They don't need to sell the property, unlike Manulife. Okay, so that is me. But of course, again, this is very high risk. Also, I am a bit tamsim. I'm actually being attracted by this 17.3%. Wow. Can you imagine? What actually give you 17.3%? This is per annum, right now. Okay, even it drop even drop to 12%. What actually give you 12% right now? But the risk is if they have to sell the property, then that's it. Forex, I mean, with 17.3%, there's enough facts for all this, if you ask me. Okay. Again, I need you all to remember the disclaimer just for me. So yes, and of course, if I have, I will not sell. So the fact is I do have. I think I bought some at 80 cents, quite pre-COVID sometimes, but I'll definitely hold them. So even those I bought at 80 cents, I'm actually still getting like yield in terms of, if I'm not wrong, at least 7 to 8% yield lah. So still quite okay. I'll still hold them. Okay, so that's for Keppel Pacific. Manulife, if I don't have, will I consider buy? Definitely no. Too risky. If I have, will I consider selling? Yes. I think getting back a bit is better than nothing. Okay, so gearing ratio now very close to 50% already. Breach condition for sell. I am if let's say I have, I would not actually keep it. Again, that's me. No need to. So Indra, no need to wait for the future. They already revised the dividend payout. It's coming down. That one is confirmed already. Yeah, no need to yeah. Later I'll show you. It's confirmed. No more 17.3. That is correct. Yes. So that 17.3 is actually based on the previous year one. So like I said, I believe that the occupancy will drop further. But then, even 17.3, let you drop to 12, to me also quite good. 12% also quite good. If you ask me. So, but this is high risk. Prime US, if I don't have, will I consider buying? No. I think they are still quite challenging for them. Okay, as per what they themselves actually say. But if I have, will I consider sell? Actually, no. I will not sell. Okay. Reason is, they still have the, what you call that? Their loan situation is not as bad. I don't think they have hit that for sale scenario yet. So if I have, I will actually still hold on. Okay, I may not want to cut loss. Again, that's me. So the difference between these two is, for this one, I think they have to take action. In fact, they have taken action already. Okay, so not very bright. For this, fingers crossed, I still hope that they don't have to force sell, because I don't want to take the loss. Okay, so but that's me. And lastly, for United Hampshire, okay, why consider buying? No, because there's not much discount. Okay, not like, they have dropped a lot. If I have, will I consider sell? Of course, definitely not, because in fact, they are not really affected. Okay, but of course, if you think that United Hampshire, their 13.1% is attractive, probably can, probably if you want, can worth the risk, if you ask me. Okay, maybe it's worth the risk. 13.1%, if you think it's actually good enough. Why it did attract me is because I think, if I remember correctly, when it was IPO at that time, the yield was also quite high one. Also, I wasn't particularly being attracted to it, but 13.1%, and you have okay the risk, I think it's actually not too bad. I think retail so far is actually not affected. Not as affected as the rest. Okay, so this is my opinion. Again, why I'm doing this is because a lot of people always ask me this question, or how do I decide to sell? Hopefully this one give you some framework. They give you some reference. If next time, if you have stocks that don't do well, do you actually want to sell? Hopefully this one will give you some idea. So basically, let's talk about selling. The key point here is this. I look at, is there still hope? Okay, so my personal mandate is I try not to lose money. Okay, and I believe in long term. Well, especially when they're giving me dividend. Okay, so as long as I believe there is a chance of comeback, okay, At the same time, I am actually getting some dividend, I usually will not sell. So that is my selling principle. But if I think that, no chance already, okay, no matter how cheap, I will also sell. Okay, so that is my principle. So of course, the other way that can help you all to think about selling here is this, after you sell away, that money, can it be deployed into somewhere better? No? If let's say, for example, prime US REIT, I'm not too sure, but if I sell, I need this money to deploy somewhere, which confirm can be better, then maybe it's worthwhile to sell. So these are the two main reasons why I sell. Number one is no hope already, sell. The other way is, that money, I actually got use for it, a better use for it, then I sell. Okay, if not, I will actually just hold it. Just hold it. Have a hope better than, sell already, then that's it, no hope. Okay, so hopefully that is clear. Okay, any questions or comments? Any questions or comments about this? Okay, please, do me this favor. Don't after that, just follow this. I'm not trying to give you recommendation. It's really the process that I want to stress upon here. Okay, all good, all good. Okay, if not, there's just one last part before I end this segment. So for Keppel Pacific Old US REIT, so in fact, it's one of my main interests because the rest actually didn't pass credit test. I'm actually not very happy. So only this one passed credit test. So this is the one that I want to spend a bit more attention. I just want to highlight something to you. Again, answer to Indra. So you can see that for FY 2002, the income available for distribution dropped already. Okay, it has dropped compared to FY 2021. So this is COVID year. This one is still COVID, but getting out. So in fact, it actually dropped. And if you actually look at the first quarter of 2023, compared to 1Q 2022, also already dropped already. So no need to wait for them to drop, confirm or drop. Okay. The only thing is 17.3%, I have enough facts for it to drop. That is my thinking process. Of course, don't have to agree with me. It's high risk. If this risk cannot bear, you can totally avoid all this. Look at something else. Doesn't mean that, this is like a damn good opportunity. No, it's high risk, high return at this point in time. Okay. Okay, I just want to share a few in terms of their debt. So this is one thing I like about Akong related company. They manage their debt quite well. So 38.7%, quite safe, 3.6 times pass, quite well spread out. As you can see, you don't have any particular year more than 35%. So to me, this is considered quite well spread out. Fixed debt 77.9% fixed. So only 22. So again, won't be hit a lot by the interest rate. Okay. I have done a pricing analysis. Okay. So by the way, this is the precise calculation. 17.3, I actually got it from the SGX stock screener. So I did the precise calculation. If I were to use the past 12 months, past 12 months dividend is actually 58 cents. Current price is 305. By the way, all these are in US dollar, USD. The dividend yield is actually 19%. 19%. Okay. If we were to look at past 4 years, the average dividend yield is about 8.6%. 8.6%. So maybe answer to Valerie, this is what I mean by oversold. 19%, 8.6. If you tell me that dividend is going to drop, Dividend going to drop, yeah lah, I adjust the price, okay lah, but wow, now I am getting, how should I say, the dividend yield is actually so high right now compared to what a fair yield is. I think even this one drop, even dividend drop a bit, I buy at this price, I'm still getting quite good dividend yield. That's what I'm trying to say here. Okay. So that's all I have for the first part of today's sharing. Anybody has any questions, comments? Huh? So I basically think that the price dropped too much. Dropped down too much. So 66 cents, you tell me maybe drop to 50 cents. Yeah, I agree lah. Okay, but actually dropped to 30 cents, which is kind of you. Okay, let me just calculate something more precisely. So if let's say, for example, based on 30 cents, 0.086 times 30 cents. Okay. So basically, if let's say, okay, this is the fair yield, right? At 30 cents, that means the dividend is about 2.5 cents. 2.5 cents, 2.5 cents. Okay. That means you're actually expecting their occupancy to drop by almost 50%. Okay, I'm not too sure you all understand our calculation. So basically, this is what happened here. So assuming that the fair yield is 8.6%, so at 30 cents, 8.6% times 30 cents, that means the dividend is 2.5 cents. Sorry, yeah, 2.5 cents, correct. So unless you believe that the dividend really dropped to 2.5 cents, which means occupancy almost dropped by half. Okay. If not, this is what we call oversold. That means the price dropped too much. Okay, hope this is clear.